When it comes to investing in dividend stocks, you have a couple of options. You can invest in individual companies that pay dividends, and with that brings higher risk and higher reward. Another way to invest in dividend stocks is through ETFs, or exchange traded funds. ETFs can hold a number of different stocks, hundreds or even thousands for some ETFs of individual companies. So you get a basket of stocks. It allows you to diversify your portfolio just with one simple investment. On this channel a lot, we talk about individual stocks, stocks I'm buying, stocks I'm following closely. But today we're going to take a look at 3 dividend paying ETFs that can compound your wealth. So if you're ready for today's video, do me a huge favor before we begin. Click that like button down below, subscribe to the channel so you're notified anytime we drop new content. And with that being said, let's get into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please perform your own due diligence before investing in any stock. And I'd like to take a moment to thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now, completely free. Check out the link down in the description below. With that being said, let's jump back into our video covering 3 dividend ETFs to compound your wealth. And when we talk about compounding, the power of compounding cannot be denied. You can compound through share price appreciation. You can compound just through dividends, reinvesting those back into the investment to add more shares. Or you can compound through dividend growth. All 3 of these dividend ETFs we're covering today offer all of these. Let's begin with our first dividend ETF, which is the Vanguard Dividend Appreciation ETF, stock ticker VIG. So with this ETF, they are focused on dividend growth. I prefer dividend growth, but with that usually comes a little bit lower yield, but stronger dividend growth year in and year out with the hopes of outpacing inflation, something that's been a tall task to do over the past few years. VIG was an ETF that was launched back in 2006, so it has been around for quite a while, and it is managed by the Vanguard Group. The ETF replicates the S&P US Dividend Growers Index, so as you can imagine, dividend growth is front and center. VIG has $69 billion in assets under management, or AUM, and they have a low expense ratio of just 0.06%. When you look back over the past 5 years, the ETF is up 50%, underperforming the S&P 500 by only 5%. VIG is a ETF that offers a good balance of both growth, dividend growth, and a defensive nature. Speaking of that balance, here's a look at the ETF's sector breakdown. It is led by technology with an exposure rate of nearly 23%, then financials 18%, healthcare at 15.5%, industrials at 13%, and rounding out the top 5 in terms of sectors is the consumer defensive sector with 12% exposure. Pretty well spread out with technology leading the way. Now let's take a look at the top 10 individual holdings as of the end of July. They include Microsoft, Apple, United Health, JP Morgan, J&J, ExxonMobil, Procter & Gamble, Visa, Broadcom, and the Home Depot. The ETF has a total of 317 total positions, so not as many as the S&P 500, but still large nonetheless. The top 10 holdings account for 31% exposure, with no single position accounting for more than 4.8%. In terms of the dividend, over the past 12 months, the ETF has distributed $3.11 per share, which equates to a dividend yield of nearly 2%. On top of that, investors have seen the dividend increase for 9 consecutive years with a 5-year dividend growth rate close to 10%. So a very well-rounded ETF. It has a low expense fee, some great holdings, and solid dividend growth. Now let's move on to the second dividend ETF, which is the Pacer US Cash Cows 100 ETF, stock ticker COWZ. This ETF is not one I've covered on this channel before, but I have written about the ETF in the past. And if you are around or understand dividend investing, then you understand the fact that one of the most important things you need in order to pay a dividend, yet alone a growing dividend, is free cash flow. Far too often, investors solely focus on net income or that payout ratio, but really where the dividend is paid from is from free cash flow. So you want to focus on free cash flow yield, and the free cash flow payout ratio, especially when you're dealing with dividend stocks. This is exactly what the COWS ETF does. And if that's not the best ETF name, it's up there. COWS is focused on screening the Russell 1000 for the top 100 companies based on free cash flow yield. And for those unaware, free cash flow is the cash remaining after paying all your operating expenses, interest, taxes, and long-term investments. Free cash flow is what's used to pay the dividends, pay down long-term debt, and reinvest back into the business. So once we narrow it down from the Russell 1000, we take the highest yielding free cash flow stocks. We're left with 100. Those 100 companies is what makes up this ETF. Each position is then outlined into the ETF based on the one having the highest free cash flow yield. But no position can account for more than 2% at the time of rebalance, which is done on a quarterly basis. The ETF has an expense ratio of just 0.49%, so a little bit higher than what we just saw with VIG, and they have AUM of $15 billion. Now let's take a look at the sector breakdown. Energy is by far the largest with 37% exposure rate, followed by healthcare at 15%, consumer cyclical at 14%, materials at 13%, and technology at 8%. So very heavy energy with COWS ETF. Now, when we look at the top 10 list, it should not come as a surprise that energy dominates. But again, no position starts above 2% at the same time, at the start of rebalancing. But they can grow beyond that with the increase in the share price. So here's a look at the top 10, which include Chevron, Marathon Petroleum, Nucor, Valero, Booking Holdings, Phillips 66, ConocoPhillips, Pioneer Natural Resources, Diamondback Energy, and EOG Resources. I think Booking Holdings is the only non-energy play within that top 10. These top 10 stocks make up 22% in total, and COWS has a total of 102 total positions. In terms of the dividend, over the past 12 months, the ETF has distributed 95 cents per share, which equates to a dividend yield of 1.8%. The ETF has a 5-year dividend growth rate of 10.3% as well, so the dividend stats look very similar to that of what we just saw from VIG. So to like COWS, you really got to like cash flow, but you also have to be comfortable with having a higher exposure rate to the energy sector. Now let's move on to our third dividend ETF, which is the Schwab US Dividend Equity ETF, stock ticker SCHD. How can we go through a dividend ETF video and not mention the king of dividend ETFs, which is SCHD? SCHD is the most well-known dividend ETF with assets under management of nearly $50 billion, and they have a low expense fee in line with VIG at 0.06%. What is it that makes SCHD so popular, you might ask? Well, when it comes to dividend stocks, they usually fit in a bucket. You can have a dividend stock that is a growth stock, so maybe it has a much lower yield, but they do have a dividend, but they also offer a lot more potential in terms of share price appreciation. Think of a stock like Apple. Another type of dividend stock is a high yield dividend stock. Now, they obviously have a much higher yield. They're going to have a lot lower growth in terms of both share price growth as well as dividend growth. But then you have dividend growth, which can really fit in either of those buckets, but they tend to have lower yields, but much faster dividend growth of 10% or more per year. And when it comes to SCHD, they have all three. It offers a dividend yield that's higher than a lot of high yield dividend ETFs. It offers dividend growth that's higher than dividend growth ETFs. So SCHD is going to have a higher dividend growth rate than that of VIG, which is focused solely on dividend growth. And then they usually offer a lot more growth potential in terms of share price appreciation. But like we've seen in 2023, the leading sectors have been technology and communications. And when you look at the sector breakdown here in a second, you're going to see that those are the fifth and seventh top sectors in terms of SCHD. So not having technology as number one is what has weighed on SCHD. So looking here at the sector breakdown, you can see the largest sector is industrials, which has an 18% exposure rate, followed by healthcare, financials, consumer defensive, and then technology at 12.5%. So as I mentioned, technology and communications have been the far and away leaders in 2023, but they only count for 12.5% and 4% respectively within SCHD. Now let's take a look at the top 10 holdings, which include Amgen, Cisco, Broadcom, the Home Depot, AbbVie, Merck, the Coca-Cola Company, PepsiCo, United Parcel Service, and Chevron. These top 10 stocks account for 41% exposure, and in total, SCHD is invested in 104 total positions as of the end of August. And lastly, let's take a look at the dividend stats. Over the past 12 months, SCHD has paid out a dividend of $2.60 per share, which currently equates to a dividend yield of 3.5%. And as you can see on this chart here, investors in SCHD have enjoyed a growing dividend for 11 consecutive years. And they have a 5-year dividend growth rate, SCHD that is, of nearly 14%. So as you can see right there, perfect example. Not only do they have the highest yield, which is higher than the likes of HDV or VYM, which are two popular high yield dividend ETFs, but also they have the fastest growing dividend, faster than that of VIG, which we looked at today, and the likes of DGRO, two dividend growth focused ETFs. Down in the comments section down below, let me know which of these 3 dividend ETFs is your favorite. Is it the king of dividend ETFs in SCHD, or is it the dividend growth ETF, or the free cash flow with the code name COWS, which I think is pretty awesome. Thanks again for watching. I hope you enjoyed the video, and if you haven't done so yet, make sure you smash that like button down below, as it really helps us spread the word, grow the channel, and I truly appreciate it. And with that being said, we'll see you in the next video. Take care.